Warren Buffett is the greatest investor of all time. If you had invested $1,000 in his investment company when it started, it would be worth over $30 million today. Such returns seem unrealistic, but how did Buffett actually do it? The answer is he understands what most people don't and is sticking to a few key principles that you can implement in your everyday life. Keep watching because by the end of this video, you will learn all of them. We look for three things when we hire people. We look for intelligence, we look for initiative or energy, and we look for integrity. And if they don't have the latter, the first two will kill you. Because if you're going to get somebody without integrity, you want them lazy and dumb. You don't want them smart and energetic. So the answer is that investors behave in very human ways. They get very excited during bull markets and look in the rearview mirror and say, I made money last year, I'm going to make more money this year. So this time I'll borrow. Or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. They're always looking in the rearview mirror. When they see a lot of money being made in the last few years, they plow in and push prices up. When they see no money being made, they just say, this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for a huge opportunity. There's no doubt about it. I was taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. This made a big impression on me, so I went around looking for what I call cigar butts of stocks. The cigar butt approach to buying stocks is simple. You walk down the street and look for cigarette butts. You find this cigar, which is honestly terrible looking, soggy, and ugly. You pick it up and get your one puff. It's free, it's cheap. Then you look around for another cigar. This is what I did for years. It's a mistake, although you make money doing it. But you can't make it with big money. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. It's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake, although you make money doing it, but you can't make it with big money. It's much easier to buy wonderful businesses. I'd rather buy a wonderful business at a fair price than a fair business at a wonderful price. I believe you can only make money in things you understand. I don't mean to understand what the product does. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics will say Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market and have brands like Double Mint, Spearmint, and Juicy Fruit, they will still be there 10 years from now. I can't pinpoint the exact numbers for Wrigley, but I'm confident that I can make an informed guess. Evaluating that company is within my circle of competence. I understand what they do, I understand the economics of it, and I understand the competitive aspects of the business. The biggest mistakes we've made by far, biggest mistakes I've made by far, are mistakes of omission, not commission. They're the things I knew enough to do. They were within my remit, and I sucked my thumb. And those are the ones that really hurt. They don't show up anywhere. I probably cost Berkshire at least $5 billion by sucking my thumb 20 years ago or so. A Fannie Mae had some problems and we could have bought the whole company for practically nothing. You have to take the big opportunities in life. We don't do a lot of things, but when we get a chance to do something that's right and big, we have to do it. And doing it on a small scale is almost as big a mistake as not doing it at all. You really have to take them when they come. Because you're not going to get 500 great opportunities. You would be better off if when you came out of school here, you had a punch card with 20 punches on it, and every time you made a big financial decision, you used up one punch. You'd be very rich because you'd think very hard. Each of you would go to a cocktail party and someone would talk about a company. You didn't even understand what they did or couldn't pronounce the name, but they made some money last week. And another one like it, you wouldn't buy it if you only had 20 stamps on the card. As far as our wholly owned companies go, we're not going to sell them, no matter how much somebody offers us for them. If somebody offers us 3 times what it's worth, we're not going to sell it. I may be wrong in that approach. I know I'm not wrong to own 100% of Berkshire because that's the way I want to live my life. I've got all the money I need. It's just a matter of changing the newspaper story on my obituary and the amount of money the foundation has, and breaking off relationships with people I like and people who have joined me because they think it's a permanent home. To do that just because somebody waves a big check at me would be like selling one of my children because I'm going to wave a big check. So I'm not going to do that. And I want to tell my partners that I'm not going to do it, so they're not disappointed in me. More and more with certain stocks, we've got that approach now. If we were chronically underfunded and there were all sorts of opportunities, we might have a slightly different approach. But our inclination is not to sell things unless we get really discouraged, perhaps with management, or we think the economic characteristics of the business are changing in a big way. But we're not going to sell just because it looks too high in all likelihood. Now let's go over here. Hello, Mr. Buffett. I have two quick questions. One is, how do you find the intrinsic value of a company? Well, intrinsic value is the number that, if you knew everything about the future and could predict all the cash that a company would give you between now and Judgment Day, discounted at the appropriate discount rate, that number is the intrinsic value of companies. In other words, if you want to take the steps to financial freedom as quickly as possible, don't forget to like the video and subscribe to the channel. The only reason to make an investment and lay out money now is to get more money later on. That's what investing is all about. When you look at a stock or bond, it's very easy to tell what you're going to get back. It's right there on the bond. It says when you get the interest payments and when you get the principal. It's simple to determine the value of a bond. It can fluctuate tomorrow due to interest rate changes, but the cash flows are clearly stated on the bond. Analysts are responsible for transforming stock certificates into bonds, which represent an interest in the business. They then forecast future payments. When we buy a new machine for Shaw to make carpet, that's what we're thinking about. It's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. If you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you. The question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after, as you get further out. But that is the question. How much cash are they going to give you? This isn't about how many analysts are going to recommend it, what the volume in the stock is, what the chart looks like, or anything else. It's about how much cash it's going to get you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset, oil in the ground, you're laying out cash now to get more cash back later on. And the question is, how much you're going to get, when you're going to get it, and how sure are you? When I calculate the intrinsic value of a business, whether we're buying all of it or just a piece of it, I always think we're buying the whole business. That's my approach. I look at it and ask, what will come out of this business and when? And what you really want is for them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say 105 or so billion now. What can we distribute? From that 100, if you're going to buy the whole company for 105 billion now, we need to be able to distribute enough cash to you soon enough to make it sensible at present interest rates, to lay out that cash now. That's what it comes down to. If you can't answer that question, you can't buy the stock. You can gamble in the stock if you want to, or your neighbors can buy it. If you can't answer that question, I can't answer it for internet companies, for example, a lot of companies, all kinds of companies. I just stay away from those. If you want to take the steps to financial freedom as quickly as possible, don't forget to like the video and subscribe to the channel.